Welcome to the deep dive. If you're listening, you've probably put in the hours, you've back-tested your strategies, and you have a solid idea of what you think the market should do. You're definitely past the beginner phase.
Yeah, you know the theory.
Exactly. But here's that reality check we all face. A brilliant strategy is, it's often only half the battle. The other half, the part that really separates consistency from frustration, is all about execution. So if you're ready to move beyond just the theory and get a real competitive edge, this deep dive is absolutely for you.
I think this is such a critical topic.
Today, we're pulling apart some key concepts from mastering advanced trade execution techniques, which is a really detailed look at timing and precision. Our whole mission here is to show you how to go from just placing orders to truly optimizing your entries and exits.
And that's the key transition, right? For the intermediate trader, the focus has to shift. Beginners are obsessed with the signal, the strategy.
Oh, when to buy.
The when to buy, exactly. But as you, the listener, start trading more often, maybe with bigger sizes, all those tiny little inefficiencies in how you get in and out of the market, they just become huge, measurable holes in your profits.
You really add up.
Oh, they calm down. We're talking about the silent costs. Things like slippage, transaction fees, even missed opportunities. These things can just, they can quietly eat away all the profit. Your brilliant strategy just worked so hard to find. This is all about refinement.
Okay, let's unpack this. Mastering advanced execution ensures trades are executed swiftly and accurately. It's the difference between catching an opportunity when you planned and watching the price just run away from you before your order even gets filtered. So let's start with those foundational goals. It really boils down to precision, right? At your entry and your exit points, it sounds simple. Just hit the price you want. But the devil is in the details of the price you actually get.
And that connects right back to cost management. At its root, all advanced execution is just rigorous cost management. You have to learn not just to accept, but to actively limit slippage.
And for anyone who's not totally clear, slippage is just that gap between the price you clicked and the price you got filled at, right?
Exactly. It's the difference between the expected price and the actual fill price. So if you place a market order to buy at, say, $10, but the order actually executes at $10.03.
That 3 cents is your slippage.
That's your slippage. And that 3 cents multiplied over hundreds of trades and bigger sizes. It becomes a hidden tax on your performance. You also have to manage the spreads, that gap between the best bid and the lowest ask. Every single penny you save there goes straight to your bottom line.
But the market isn't static. It's not one single thing. You might have a great execution plan for a calm day, but how does a trader adapt when conditions just change on a dime? When volatility spikes or liquidity just vanishes?
And that's the crucial question, isn't it? Can your tactics handle the environment you're in right now? Executing in a low liquidity market, maybe a small altcoin at 3 a.m., that requires a totally different approach than executing during a major news event, like an FOMC announcement in a high volatility market.
What's the difference in approach there?
Well, in low liquidity, if you come in too big, you basically are the market. You'll move the price against yourself, guaranteed. You need patience, discretion. But in high volatility, speed is everything. You might need to prioritize just getting a fast fill over a perfect one to avoid a huge instant loss.
So timing isn't just about the chart signal, it's about reading the market's its capacity to even handle your trade at that specific moment.
Precisely. And this all ties into timing your trades beyond just technicals. It's about aligning your execution with the underlying market structure. It's that blend of strategy and pure situational awareness that really separates the pros.
Okay, so we've got the why, cost reduction, precision. Let's talk about the how, the actual tools. We have to move past just hitting buy and start deploying orders strategically to control the outcome.
Yes. This is the next level up. It starts with mastering the foundational tools: market orders, limit orders, and stop orders. But the key is to deeply understand the trade-offs of each one.
Can you walk us through that, the trade-offs in a practical sense?
Sure. A market order is a demand for speed. You get filled right now, but you accept whatever the price is. You're basically guaranteed to get slippage in a fast market.
Right. You're trading price for certainty of a fill.
Exactly. Now, a limit order is the opposite. It's a demand for a specific price. You control the price, but you risk. Well, you risk the market running away and never filling your order at all, missing the whole trade.
And stops.
And stop orders are for risk control, but once they're triggered, they act just like market orders. So they are very, very susceptible to slippage, especially in a market gap or a flash crash.
Okay, and this is where it gets really interesting for me, because now we have to move beyond just telling the broker what we want to understanding what's actually happening on the exchange in that microsecond after we click, looking under the hood.
This is where we get into market microstructure.
Yeah.
And I love your analogy. It's not a single stream. It's the plumbing of the financial system. Microstructure is just the study of how that plumbing works, how orders flow, how prices are set, all the mechanics.
That's a great way to think about it. So if my order gets sent down a slow, congested back road, my execution is going to suffer, even if my trade idea was brilliant.
That is the practical consequence, 100%.
Yeah.
Understanding that flow, the order routing, the different venues, it's essential for mastering execution. It's how you anticipate and avoid bad fills.
And this must lead directly to liquidity.
It leads directly to liquidity and its impact on execution. I mean, liquidity constraints are probably the biggest silent killer of otherwise good traders. Liquidity is just the ease with which you can buy or sell something without moving its price.
Can you paint a picture for us? High versus low liquidity.
Okay, imagine two order books. For a high liquidity asset like a major index ETF, you've got millions of shares waiting to be bought and sold, just a penny away from the current price. It's an ocean. Your trade is a tiny drop.
It barely makes a ripple.
Barely a ripple. Now imagine a low liquidity stock. There might only be 500 shares on the entire order book within 20 cents of the price. If you try to market buy 1,000 shares, well, you're going to eat through those 500 and push the price way up to find the next 500. You'll get a terrible average price.
Wow, that perfectly illustrates why just scaling up your size without thinking about liquidity is, well, it's a recipe for disaster.
Total disaster.
Now, when we talk about advanced execution, we eventually have to talk about the most sophisticated tools out there, trade execution algorithms. This might sound like something only for the big institutional desks. What role do they really play for a serious retail trader?
Their role is simply optimization. I mean, that's it. Algorithmic strategies just use logic to break down your order. They analyze the market microstructure in real time to cut down on slippage and improve timing automatically.
So it's automation for discretion.
That's a great way to put it. Instead of you manually deciding how to split up a big order, an algorithm does it. For example, a TWAP, or time-weighted average price algorithm, just breaks your order into equal pieces and executes them over, say, the next hour.
And a VWAP.
A VWAP, volume-weighted average, price is smarter. It tries to execute your order at a price close to the market's average, weighted by volume, so it executes more when the market is naturally more active, making your order less noticeable.
That makes a huge difference. So do I need to learn to code my own algorithms, or are these tools becoming more accessible now?
Thankfully, no. Many advanced brokers now offer these as built-in tools. Smart order routing or basket orders with VWAP targets. You don't need to code, but you do need to understand which tool to use and when.
And that brings us to the ultimate challenge, which you mentioned, scale. How do you deploy a really large order without your own actions moving the market against you? It's like trying to sneak a battleship into a tiny harbor without anyone noticing.
And that's where the strategies for managing large orders intelligently are critical. The core strategy behind most of these algorithms is order slicing. If you need to buy 10,000 shares, but the order book only shows 2,000 at the best price, you have to break your order into smaller, stealthier pieces to avoid spiking the price.
But doesn't that create a new risk? The risk of the market taking off before your whole order gets filled?
Absolutely. That is the constant trade-off. That's why these are called liquidity-sensitive tactics. You accept the risk of maybe only getting a partial fill in exchange for getting a much better average price on the volume you do fill. The goal is to make your execution look like it was just part of the natural market flow. Invisible.
Strategy, algorithms, order slicing, these are brilliant mechanical tools. But none of it matters without that final human element, does it? Discipline.
Oh, this is so critical. We've all seen it. A trader gives back an entire week's worth of profit in 15 minutes because they chased a fill, or they tried to force a trade when the market just wasn't there.
That emotional response.
That's it, and it's amplified in fast markets. The source material really hammers this point, avoiding overtrading. This is the operational side of discipline. It means staying rational. It means not defaulting to a sloppy, expensive market order just because you feel a bit of panic or FOMO. All the precision we've talked about goes right out the window.
So this has been a massive deep dive. Let's just quickly summarize the framework we've built today. For the intermediate trader, the goal isn't just about strategy, it's about optimizing the how. It's about precision in your entry and exit points, aggressively managing costs like slippage and spreads, and having that situational awareness to know if you're in a low liquidity or high volatility market. And then using advanced tools and knowledge, like microstructure and algorithms, to handle size intelligently.
And can I add one last crucial step? The thing that turns good execution into great, consistent execution is post-trade analysis. You have to do it. You must go back and review your fills, check the slippage. Ask yourself, did I use the right order type for that moment? That feedback loop is absolutely essential for long-term improvement.
A great final point.
And of course, we have to issue the vital reminder from the source material. Trading any financial instrument involves a significant risk of capital loss. Market volatility can be extreme, and you may lose more than your initial investment. Remember, this is purely educational content, not financial advice. Please consult a licensed financial advisor before making any investment decisions.
So what does this all mean for your next step? This journey into execution, it almost always leads deeper into understanding how the market actually works. For those who want to truly master this, we'd suggest looking into the theory behind it all. Specifically, the concept of market microstructure theory, explored by authors like Maureen O'Hara. And this raises a really important question. How deeply does understanding the literal plumbing of the financial system, the bid-ask spread, the order book depth, the exchange rules, how deeply does that influence the final outcome of your individual trades? Think about that. We'll see you next time for another Deep Dive.